And this most of the time, when you look at the balance sheet, you would see there, say, building, for example, cost was say 500,000. So you would not know how much is the value of the land and how much is for the building, right? Normally, you would go back to the client and say, do you have an appraiser's report that would have or that would show the value of the land? Kung wala, okay na naman yun. May acceptable rate yung IRS at 25%. So as accountant, you can pick 25% as the value of the land. The rest would be the value of the property. Or you can search online a reasonable basis as to how you can allocate the value of the land based on the address, right? So again, kanya-kanya ng research yan for as long as well documented naman. If in case the IRS comes back to you and questions the basis of the property, we would normally just ask for a supporting document. Again, usually the IRS, if they have doubts on the tax return, they will not process it right away. So when you file the return, it may say it's accepted, right? But it's not the end of it. So it's accepted by the IRS, but it doesn't mean it's already processed. So meron pa yung processing mangyayari sa back end. And when they see some questionable items on the tax return, the IRS will just send a notice to the taxpayer to, explain what the questions are and what needs to be done, right? So pagka ganito, question on depreciation taken on the business return. We would need this list of items. Kailangan mo lang i-comply yun, right? So what would you comply? Yung basis ng computation mo ng valuation ng property, right? So part of the working paper. Again, usually 25% is acceptable. Don't make the mistake of depreciating everything. Don't make the mistake of depreciating the entire 100% cost of the property. Because pag real property yan, syempre may pinagtatayuan yan na lupa, right?
$10,000 was attributable to the land, and that's true. We don't depreciate land, but we could take the total purchase price and just kind of split that up. The amount being allocated to land in this question is actually indifferent. Okay, so the next thing that we're given as we're going through is that it was condemned, and up to that time, she had $23,000 of depreciation. Well, she would depreciate the rental side, and that's where the depreciation would go, but there is no depreciation taken on the living side. So for the living side, her basis, still $40,000. On the rental side, let's grab our calculator, even though we probably do this in our heads, let's do this out. $40,000 minus $23,000, that's $17,000. So she had a basis at this time of $17,000. So now if we think about this as somewhat of a new problem where the city paid $70,000, well, that means they paid $35,000 for the rental half and they paid $35,000 for the living half. We'll take our basis out of that because we have to recover our basis. So we'll subtract out each of those. And easy math on the right-hand side, we've got a $5,000 loss going on for our living half. And on the rented half, we'll just grab our calculator and make sure we're good here. 35 minus 17, and I come up with $18,000. She's got an $18,000 gain on the rental half, technically. So think about the living half first, right? That's a personal asset, personal use. Interestingly, there's actually nothing you can do with that $5,000 loss. You kind of just eat it. On the rental half, the question is, do I have to recognize or can I defer that gain? And if we can defer the gain, what we're trying to do then is push that gain into lowering the asset depreciable base in any replacement property. So now take a look at the fact that she has a duplex for $85,000 that she buys as a replacement. So we're going to take $85,000 and we're going to divide that by 2. And that's $42,500. So that's $42,500 for the living side, $42,500 for the personal side. This loss, once again, you kind of just eat. There's nothing we can do on that. But on this gain, we defer it by lowering the basis of the new asset. So if we take that $42,500 and subtract out the gain, which brings our depreciable base down, which means we have less and less depreciation every year, I come up with $24,500 and $42,500 for our living side. Now the question asks, what is the basis of the replacement property? Now very nicely, it doesn't give one of these two sides as option A, B, C, or D. So what we want to do is add $42,500 plus the $42,500 on the living side to come up with $67,000 as our basis in the replacement property. So kind of a long problem for us to get there, but hopefully the crude drawing helps you out a little bit. And if nothing else, this just should help commit it to memory. So $67,000, always remember to split those assets into personal and business because you got to keep track of them separately. If the taxpayer owns an office building that he or she does not personally manage, and the office building is involuntarily converted, which of the following will qualify as replacement property with non-recognition of gain? Okay, so a very important fact here is the fact that they do not personally manage. Do not personally manage. So let's see if we can find something that is similar here in our options. And I can kind of see it popping out at me visually there is C, an apartment building which the taxpayer will not personally manage. Anything else is really not replacement property, qualified replacement property, right? I've got a retail sole proprietorship. That's not real estate. That's a retail business. So that can't qualify. I've got an interest in a gold mine, which could be real estate, but if we're talking about mineral extraction, that's depletion, if you remember that concept. We depreciate real property. So that doesn't seem to line up either, and it wouldn't either. And then finally, we have a hotel that the taxpayer will personally manage. While that is a real estate property in the hotel itself, we have this connection of earned income going on that they will do the personal management in that business. So for that reason, when we see that we have an office building that was not personally managed, we're going to try to pick up something that's as close as possible where they're not personally managing the apartment building. So for those reasons, our answer is C.
All right, so that's about it for basis. One thing you just need to really note of is, you have to know how the basis was, what was the basis for the computation of the basis. So usually, again, the document we'll look into is the closing statement, right? On the buyer's perspective. So refer to the closing statement, match that if you're preparing a business return, match that with the general ledger, right? Because usually in the balance sheet, there's only one line item for depreciable assets. So you want to know, dig into the general ledger, the transaction date, and look for the closing statement. That's for you to make sure that whatever is recorded in the books is consistent with what's shown in the supporting document. So really, this work for the basis is more of the bookkeeper's concern. Also, important thing that you need to know here is that land will never be depreciated. Okay, so when there is a new real estate property in the tax year, make sure to attribute a portion of that to the land, and you do not depreciate the land. Okay, and so the reason why you would want to know the correct basis is for you to be able to calculate the correct depreciation. Incorrect basis means incorrect depreciation, incorrect tax. Okay. Now let's move on to depreciation. And a lot of these have already been tackled in the past lessons, so let's just breeze through this. All right, guys, so good. So while that's loading, I'll just show you something. So when you're inputting an item for depreciation and it's a real property, so the way you would record loading. Right? So when you want to record depreciation for a real property building, this one here, and then this one could be the land. The land, 25%, you put it that way. Building, 75%. Okay, that's how you are going to be entering that in ProConnect. So, and just assign whatever schedule it applies to. You can do it that way. All right. Let me try to switch to another connection, guys. Give me 1 second. Maybe faster. I'm sorry. Connect number Starlink sa main. Search.
Why did the work truck break up with the warehouse? Because it was a depreciating relationship. Okay. In all seriousness, depreciation is a critically important aspect of taxation, and we've got to go through it in detail. In this study unit, we'll do just that. You'll learn that there are actually special tax depreciation rules that we need to get familiar with. We'll also see some excellent tools such as the Section 179 expense to help manage a client's tax liability. For assets that are not real or tangible personal property, we'll utilize amortization or depletion. And finally, we'll see how depreciation likely needs to be recaptured when a business disposes of an asset. Let's get into it.
Funny yung joke niya, guys. Because it was a depreciating relationship. Kayo ba meron kayong depreciating relationship? 100% depreciated. O hindi pa nagsisimulang pag-depreciate. Charot. Salvage value na lang na natitira. Anyways.
The idea of depreciation is to better align an asset's costs with the revenues generated by that asset. Let's explore how depreciation applies for tax purposes. Depreciation is really best understood with an example. Suppose you purchase a piece of machinery for $10,000. That's $10,000 going out the door for an asset that will last longer than 1 year. Thus, the amount cannot be expensed. The economics are such that the cash is gone, but the corresponding tax benefit doesn't happen until depreciation takes place. As a result, taxpayers may want to accelerate depreciation to capture that tax benefit as soon as possible. Hence, as the name would imply, accelerated cost recovery, or ACR, allows a deduction in excess of a current year's decline in economic value. Using an ACR method, you might deduct $3,000 in the first year, $2,000 in the second, and so on, rather than spreading the cost evenly over the asset's useful life. All the while, the fair market value or economic value of the asset may actually be holding steady or going down at a more steady rate. But the idea, again, is that we are simply trying to capture the tax benefit of the $10,000 cash outlay with larger deductions in the early years. So what's subject to depreciation? Well, any TPP, tangible personal property, such as machinery, buildings, and vehicles used in trade or business or held for the production of income with a determinable, limited, useful life, those all must be depreciated. For depreciation, we've got to know two basic components first, with some complexities layered on in a bit. First is basis, which is typically the cost of the property minus any salvage value. Salvage value is how much a business expects to sell the asset for after it is done being used by the business. Next, we need to know rate, which may be mandatory or elected. That's the complexity we'll cover off on shortly. It's fairly straightforward. If the depreciable basis of a machine is $10,000 and the depreciation rate is 20%, the depreciation deduction would be $2,000. For tax purposes, we want to track the basis of the asset, which is reduced each year by the depreciation allowed or allowable. Allowed is the deduction claimed on the tax return, whereas allowable is the amount that a taxpayer is entitled to deduct under any proper method. Note depreciation is not optional. It is required, and the tax code assumes a taxpayer correctly took depreciation, hence the wording of allowable. Lastly, we need to know the date placed in service. Depreciation begins in the taxable year that the property is placed in service. Property is considered placed in service when it is ready and available for a specific use. So, for example, if you purchase a machine in December but don't start using it until January, depreciation begins in January. So what methodologies can be used to determine the depreciation rate? Well, first up on our list is straight line depreciation. The formula is fairly straightforward as it gives the same amount of depreciation each year. Take the basis of the asset, subtract its salvage value, and divide the result by its useful life. So let's suppose that a business has a $1,000 asset that will have no salvage value and has a useful life of 5 years. The depreciation in that case would be $200 per year. Another option would be 150% declining balance. This approach figures depreciation at 150% of the straight line rate. Here's the technical formula right here. But if you think of it with the straight line rate, it's helpful to understand it a little better. Under straight line, our asset was depreciated for 5 years, or 1 out of every 5 years. Well, that's a fraction right there. And divide 1 by 5, and that gives you 20%. 150% of 20% would then be 30%. So that's our rate, 30%. In year one, 30% of $1,000 would be $300. Now the trick to this is where the term declining balance starts to come into play. See right here where we have to reduce the basis. So we're going to take this 300 and subtract it from the 1,000 to give us our new adjusted basis of 700. Then we will multiply that 700 times our same rate, which turns out to be 30%, and we come up with $210 for depreciation in year 2, and so on throughout the useful life. 200% declining balance works pretty much the same as 150%, except as the name would indicate, the depreciation rate is double that of the straight line. So here in our example, you can see the depreciation is even more accelerated. MAKRS is unique to tax and stands for the Modified Accelerated Cost Recovery System. It technically is comprised of 2 systems, the General Depreciation System and the Alternative Depreciation System. Most taxpayers are going to use the GDS, General Depreciation System, and will only use ADS, the Alternative Depreciation System, when required, unless they elect it. The IRS calculates and publishes defined tables of depreciation rates based on the factors you see here. Taxpayers simply use the chart to identify what the percentage of depreciation will be in a given year for an asset. Now, generally speaking, this rate will closely resemble 200% declining balance with some tweaks. You'll notice an excerpt from an IRS table in your Gleim Knowledge Transfer outline and see just how detailed the asset descriptions can be. The full charts can be found in Revenue Proclamation 8756. Depreciation on residential rental property and non-residential real estate is very consistent because of the timelines. For the former, a straight line depreciation rate is used for 27 and a half years and jumps substantially to 39 years for non-residential. We mentioned this ADS might kick in or could be elected. The depreciation under ADS is straight line with no salvage value based on prescribed useful lives. ADS kicks in when a taxpayer has listed property among other less common criteria. So what exactly is listed property? Well, generally, it's property that can have business and personal use. Most frequently, that's going to be a car. So let's pair that up with automobiles. Specifically for automobiles is something the tax code defines as a luxury automobile. The main criteria for a luxury automobile is that it weighs less than 6,000 pounds. That's most passenger cars, which could be used for personal purposes, hence they would be listed property. With listed property, depreciation may be limited in a given year, but also limited overall by the qualified business use percentage, or QBU. The magical threshold of QBU is 50%. As long as business use is above and remains above 50%, depreciation is just done with regular MAKRS depreciation. However, if the use is below 50%, the ADS is required. Note if the business use for the asset drops below 50% after at least a year of claiming regular depreciation, a recapture of benefit may need to happen. All right, so back to luxury automobiles. We need to consider another limit imposed by Section 280F of the Internal Revenue Code. This code section limits the overall depreciation that can be taken on a luxury automobile in a given year. These adjustments are adjusted for inflation each year, so please check your Gleim Knowledge Transfer outline for the most up-to-date amounts. The limit for the first year may be increased under Section 168K with an additional $8,000 of depreciation. These amounts are the hard limit, meaning if regular MAKRS depreciation is less, the lesser amount is taken. All right, well, that's our coverage for depreciation methods. Thanks for watching. The K&L partnership owned the following tangible property: Which one is not considered listed property?
Find you guys. Find you guys.
Okay, so you should recall back to your Gleim knowledge transfer outline that listed property is any property that could potentially be used for personal purposes, not just business purposes. And that's the whole idea of reporting listed property. So could we use an automobile for personal purposes? Yeah, you definitely could. A video camera? Absolutely. A recreational property used for personal use 40% of the time? Heck, we even tell you it's used personally 40% of the time. Definitely listed property. The last one, a truck weighing 17,000 pounds designed to carry cargo. That's not really a good personal vehicle. They're not designed for really carrying passengers other than maybe the two folks up front. It is definitely a cargo van, a cargo box truck, not really conducive to picking your kids up after school, if you will. So I'm not seeing any personal usage there. And that's kind of the key of picking up on listed property. So D's our answer.
Right. Listed because waiting.
Most tangible, depreciable property.
Pwedeng gamitin for personal purposes. And most of the time, example nito is vehicle. Kasi vehicle kapag nagka-compute tayo ng mileage deduction. So, pinaka-common vehicle because it's used for both business and personal. Huwag lang yung cargo. Cargo, usually 100% used for business. Hindi mo sabi ni TJ, hindi mo daw pwedeng pangsundo ng anak mo sa school. Right? So, that is not a listed property.
Property falls within the general rules of makers. Most tangible, depreciable property falls within the general rules of makers. However, the law requires use of the ADS for certain property. ADS must be used for all of the following except. So if it's ADS except, so which one probably follows makers? Let's take a look.
Most tangible depreciable property falls within the general rule of makers. However, the law requires use of ADS for each property. ADS must be used for all of the following exempts.
Tax exempt use property, tax exempt bond finance property, tangible personal property, or tangible property used predominantly outside the United States during the year. Makers is really, they even say it here, the general rule. So if that's the general rule, what is generally going to have makers? That's going to be your TPP, your tangible personal property. It's very accurate that the rest of these are required to use ADS. So by process of elimination is one approach, but here I'm just trying to show you, thinking about it, just flipping this around, that if ADS is all of these, which one would probably follow the general rule? And that's how we got our answer is C, tangible personal property.
We're going to discuss Section 179 expensing and its implication for taxes. This is a powerful tool for taxpayers to elect the immediate expensing of some or all of an asset. So let's define Section 179 property. It must be tangible personal property, or TPP. This includes physical assets that are depreciable and used in business. It must also be Section 1245 property, meaning either tangible or intangible personal property subject to depreciation or amortization. What qualifies as tangible personal property under Section 179? Tangible personal property includes items like machinery, equipment, and vehicles used in the business. For example, if you purchase a new delivery van for your business, it qualifies as Section 179 property. Note the property must be bought, not inherited or gifted. The property must be acquired from someone who is not related to the taxpayer. And finally, the property must be used in the active conduct of a trade or business. You might ask, why does the property need to be purchased from an unrelated party? Seems like an odd requirement. Well, that rule prevents potential abuse of the deduction by ensuring that the transaction is at arm's length, reflecting a fair market value. The definition of Section 179 property has been expanded a bit to include a few additional components. Lodging property includes tangible personal property used predominantly to furnish lodging, like hotel furniture. Qualified real property includes improvements to non-residential real property such as roofs, security systems, fire protection systems, HVAC systems. Let's suppose a taxpayer installs a new HVAC system in their office building. It qualifies as Section 179 property. This allows the taxpayer to deduct the cost of the system in the year it is placed in service. Qualified energy efficient property is any Section 1250 property with allowable depreciation or amortization. It must be part of the building's heating, cooling, ventilation, or hot water system, meeting a standard for energy efficiency in buildings. This ensures that the property meets specific energy saving criteria. So while we might say in practice immediate expensing, Section 179 is technically depreciation. It reduces the basis of the property before computing other depreciation deductions. Now, because this is depreciation, Section 179 is subject to recapture under Section 1245 if the property is disposed of. Recapture means that if you sell the property, you may have to report some of the previously deducted depreciation as income. There are limits as to how much Section 179 can be taken in a given year. This overall limit is then phased out based on the total amount of property placed in service for the year, as well as the taxable income. These amounts all adjust for inflation each year, so please review your GLIME Knowledge Transfer outline for the current amounts. Note trusts and estates cannot claim a Section 179 deduction. Also, only the business use portion of the property cost can be expensed. And finally, there are statutory limits which apply to Section 179 on cars and certain luxury items. The good news, however, is that any excess Section 179 deduction over taxable income can be carried forward to subsequent years. Bonus depreciation, while different than Section 179, should be considered here as well. In the first year of an asset, a business must, unless they opt out of bonus, immediately depreciate a given percentage of the asset. If we were to chart depreciation on a graph, it would look something like this, where we have time over depreciation of the asset and curves down something like that. Bonus depreciation has been phasing out over the last couple of years, so please check your GLIME Knowledge Transfer outline for the current percentage. What bonus depreciation does in drawing is it drops and immediately depreciates the asset, and then regular maker's depreciation kicks in. In order to be eligible for the property to be subject to bonus depreciation, it must be in its first use by the taxpayer, meaning it actually could be used property. The property must be 20-year or less maker's recovery and can be a leasehold improvement. However, the property may not be from a related party. All right, so to wrap this up, the order applied to an asset is Section 179 first, then bonus depreciation, and then regular depreciation. If the asset is disposed of before the end of its maker's life, there must be a recapture of the Section 179 to the extent of maker's excess. All right.
Right. So things to know about Section 179 and bonus depreciation. These are, again, usually used for maximizing depreciation. The higher the depreciation on the earlier years of the asset, the better it is for cash flow purposes. on the part of the taxpayer. So they would always want to avail of these special depreciation. So the order of taking depreciation is Section 179. And how do you know if the asset is qualified for Section 179? Look it up from prior year. If there is already Section 179 in the prior year, it's going to show in the depreciation schedule. So see here, when you're entering the asset for the first time, it's going to ask you if there was a Section 179 prior Section 179 depreciation taken. So there's current and then there's prior, right? Prior Section 179 expense. If it's your first time entering that, so of course there's not going to be prior, but how do you know how much is the Section 179? Usually it's 100%. So what you do is just look it up online and see what's the depreciation or how much is the Section 179 depreciation for that particular asset. Almost all asset naman ay capable except for those like yung mga property na more than 27 and more than 20 years yung life, then they cannot qualify for Section 179. Anything below that usually qualifies for Section 179 and it's almost always 100%. So on the first year. Pag hindi 100% yung Section 179, if there's an excess basis, then it can qualify for bonus depreciation. Tapos pag may excess pa talaga, only then the regular depreciation applies. So Section 179, bonus depreciation, and the regular depreciation. It only happens kapag ang taxpayer is engaged in purchase of properties. Heavily invested siya sa properties kasi na-maximize niya yung yearly limitation ng Section 179, which is malalaki. I think nasa 20 million yata per year yung limitation. But bihira naman yung mga businesses na ganun yung level of activity in terms of purchasing depreciable properties. So usually hindi nila na-maximize yung annual limitation. So again, most of the time na-maximize na 100% use yung Section 179. One thing lang that you need to know sa Section 179 is that it cannot reduce the taxable income to negative, right? So kung ang loss or kung Section 179 is, let's say, nasa 10,000 yung depreciation and then the profit is nasa 5,000 lang. So yung Section 179 would be limited up to 5,000. It cannot take the entire 10,000 because the Section 179 cannot further reduce the loss to zero. And bonus can as well as regular depreciation. But Section 179, it cannot. Okay, that's one thing you need to remember. And then again, if you're confronted with a question on whether that asset is qualified for Section 179, research nila. ChatGPT can help you with that. And again, most of the time, it is qualified for Section 179. And huwag niyo kalimutan because it's really going to help your taxpayer reduce the tax obligation for that particular year.
All right, that's Section 179. Thanks for watching.
On January 15th, 2024, Amber purchased a car for $20,000. She used the car 75% for business during 2024. What is the maximum Section 179 deduction and depreciation Amber may elect to claim on her income tax return for 24, assuming she forgoes additional first-year depreciation? Okay, so
Amber purchased car 20,000. She used the car 75% for the business during 2024. So this is a listed property. What is maximum Section 179 deduction and depreciation Amber may elect to claim on her income tax return for 20, assuming she forgoes additional first-year depreciation. So forgoes meaning like yung bonus depreciation and all other depreciation. Is it 100%? Is it the entire 75%? Let's see.
One of the pieces I want you to commit to memory, depending on when you take the exam, when you sit for the exam, is the Section 179 thresholds. Now, in 2024, and your GLIME knowledge transfer outline will be up to date. So make sure you're checking this for every applicable year, but the mechanics are the same. In 2024, the max for Section 179 is $1,220,000. That is the max Section 179. All right. That's the most that we could possibly take. But
1.2 lang.
there is a special application for automobiles that we have to consider as well. And automobiles do have a specific capital recovery deduction limit. And in 2024, that amount is $12,400. The other caveat that we have to consider here is the fact that she uses the car 75% of the time for business. So these amounts that I've listed off over here, that would be 100%, but we need to consider 75% of those. So I'm going to take 12,400 times 0.75. So let's grab our calculator and we'll go 12,400 times 0.75, and that comes up with 9,000.
In real practice as well, you don't need the calculation because whenever you input the asset, you fill out everything, all the necessary input fields.
2024, Mary Jane placed in service a machine that cost $3,790,000. If she placed no other Section 179 property in service during the year and forgoes additional first-year depreciation, how much is her Section 179 maximum dollar amount? Okay, so
You're trying to 3,790. If she placed no other Section 179 property in service during the year and forgoes additional first-year depreciation, how much is her Section 179?
one of the things I want you to commit to memory are the Section 179 thresholds for the year that is applicable when you take the exam. Your GLIME knowledge transfer outline will be updated in 2024. Our limits are $1,220,000 of potential Section 179 depreciation. The problem is she is well over the $1,220,000 placed in service. There is then a second threshold I need you to commit to memory, which is the maximum property placed in service. And the maximum property placed in service that we could possibly have for this particular year is $3,050,000. So that is the max property. Okay, so what do we do with that max property? If she placed $3,790,000 in service, I subtract out the max. So let's grab our calculator. 3,790 followed by 3 more zeros. Subtract out 3,050, 3 more zeros, and I get $740,000. So Mary Jane is $740,000 over the max that she possibly could have placed in service. So what happens is there's a dollar for dollar reduction in the max that she could possibly put in service. So she could take a maximum of $1,220,000, but I'm going to subtract from that the $740,000 that she is over and phases out of that amount. So we're going to subtract that. So let's grab our calculator. $1,220,000. Subtract out $740,000, and we get $480,000. And sure enough, D ends up being our answer. So let me just bring that over here. 480. That's the max that we could possibly do. And you can see there that D is the answer. $480,000 is the maximum Section 179 for this taxpayer.
Amortization is the cost recovery of intangible assets, similar to how depreciation is the cost recovery for tangible assets in real property. Let's take a look at this concept. So amortization accounts for the recovery of capital ratably, meaning in equal installments over the useful life of the property. Let's suppose if you have an intangible asset with a useful life of 10 years and a cost of $10,000, you would amortize $1,000 each year. Generally, amortizable assets are intangible, personal property with a determinable useful life, and are used in a trade or business for the production of income. Expanding on this, we would include property, intangible property, for things like patents, copyrights, trademarks, personal property as opposed to real property, which is land or buildings, assets with a determinable useful life, meaning the asset must have a clear, finite period of usefulness, and finally, assets with a business use, meaning the asset must be used in a trade or business or for the production of income. The deduction is taken in equal installments over the useful life of the asset. There is a special category called Section 197 intangibles, which are specific types of intangible assets acquired in a trade, business, or income-producing activity. Section 197 includes goodwill, going concern value, and other intangible assets like customer lists and trademarks. These are amortized over a 15-year period, starting from the month the intangibles are acquired. So, for example, a patent on a new technology is an intangible asset. If you acquire a patent for $15,000 and it has a useful life of 15 years, you would amortize $1,000 each year. Qualified intangibles include goodwill and going concern value, which is value derived from the reputation and ongoing operations of a business. It also includes workforce and information base, which could be trained workforce or databases. Patents and copyrights are also included, which is the legal rights to inventions and creative works. We'd also pick up licenses and permits, which are rights granted by governmental units. Also, covenants not to compete, which are agreements restricting competition. And finally, we'd pick up franchises and trademarks, which are rights to operate a business or use a brand name. Given this list, it certainly stands to reason we would ask the question, well, are there any intangibles that don't qualify for amortization? And interestingly, yes, intangibles that result from the taxpayer's own efforts, unless acquired in connection with a trade or business, do not qualify. Also, interests in corporations, partnerships, trusts, estates, land, most financial instruments, and leases of intangible personal property are also excluded. The basis of an intangible is usually the cost to buy or create it, including all acquisition costs and necessary expenditures to make the asset ready for use. Unsubstantiated expenses for creative effort are not included in the basis. If you sell a qualified intangible and retain other intangibles acquired in the same transaction, any loss realized on the disposition is actually disallowed. The disallowed amount is added to the basis of the retained intangibles. Startup costs can be amortized over 180 months, starting with the month when the business begins. So, for example, if you incur $18,000 in startup costs, you can deduct $100 per month over 180 months. So what exactly are startup costs? Well, startup costs are expenses paid or incurred in connection with starting or investigating the start of or acquisition of an active trade or business. They can also be allowed as a current deduction if they are for the expansion of an existing business. This includes expenses related to starting or investigating a business, but does not include the purchase price of property to be used in the business, such as land, buildings, or equipment. If the business is not started or acquired, the costs are not deductible unless the person is already engaged in a similar line of business. Organizational expenses of a corporation or partnership are generally capitalized, but can be amortized over at least 180 months. Up to $5,000 of startup expenses and organization costs may be deducted in the first year. If the costs exceed $50,000, the $5,000 deduction is reduced dollar for dollar above $50,000. So, for example, if you have $52,000 in costs, your first year deduction would be reduced dollar for dollar down to $3,000. This is an automatic election, meaning a taxpayer is deemed to have made the election to amortize and does not need to attach a separate statement to the return. The cost of acquiring assets is included as part of the cost of the assets, so those aren't organizational costs. Similarly to that, construction period interest must be capitalized and recovered under applicable depreciation rules. Amortization is not permitted for these costs. Lastly, and sort of an odd one, sometimes it costs money to even acquire a lease on an asset. This could be paid to a broker or a finder's fee of sorts. These costs for acquiring a lease are amortized over the lease term. So, for example, $10,000 in commissions paid to acquire the lease, a 10-year lease, would be amortized at $1,000 per year. Renewal options are included in the lease term if less than 75% of the cost is attributable to the period prior to the renewal. Finally, improvements by the lessee are deducted through maker's depreciation according to the type of improvement. Those leasehold improvements would not be picked up in amortization. All right, that's our wrap on amortization. Thanks for watching.
All right, time check, 8:59 from bilis ng oras. So I don't think we can finish depreciation. We still have the few questions for amortization and depletion and then depreciation recapture. For those who feel like this is too much, it's okay, guys. This is just the why. Really, the reason why I also breeze through with this one, because these are already calculated in the software. You don't need to do the calculation, but it's a good to know thing, right? You understand the logic behind the computation. Cherry, yes, it will be Kahoots tomorrow for sure. And then thank you, by the way, Cherry, for sharing some tidbits in the chat. Yeah, so again, a lot of these information are already in the software. You don't need to memorize. If you are taking the EA exam, yeah, these are good resource. And yeah, it's just good to know. Nothing too serious to memorize or basically what I'm trying to say is don't take it too seriously, right? If mission na overwhelm kayo because the tax software are already very smart enough that all you need to do is to fill out the forms and everything's going to be done for you. Alrighty. So having said that, I'll say let's call it a day. Let's see if Gina Lynn is still here. Do you mind closing today's session with a prayer?
Yes, Chris.
All right, go ahead, please. Thank you.
Lord, as the session closes today, we are thankful and grateful for the learnings and knowledge imparted to us. Though things might not clear to all of us this time, let your grace give us the clarity to understand and put these learnings into practice. We are humbly asking your help, the willingness to continue this journey so it may change lives of all of us here. This we pray in Jesus' name. Amen.
All right, amen. Thank you, Jean, and thank you guys for joining us today. I'll see you guys again tomorrow. All have a good one. Thank you, guys.